Kitco News special coverage of the Precious Metals Summit is brought to you by Corvus Gold.
We're joined now by Rick Rule, virtually. He is a legendary investor in the metals and mining space, and he is now the CEO of RuleInvestmentMedia.com, and he is a director of Sprott. Welcome back to the show, Rick. I'm sorry we couldn't be in person at the Beaver Creek Summit.
Well, it's always a pleasure to be interviewed by you, either physically or virtually. I look forward to the day when we can, in fact, meet face-to-face, but for the time being, this is the best we can do.
I'm sure that day will come very soon, Rick. I'd like to talk about, first and foremost, the uranium market. We haven't caught up about the uranium market, you and I, for quite a while. As you are aware, the price of uranium has finally found some life. It has skyrocketed. It wasn't even just a gradual move up. It was a parabolic move in a very short amount of time, from $30 to $40 a pound. The futures market just breached $40 a pound. So fundamentals. Let's talk about the fundamentals first, about the uranium price action that we've seen, and then we can talk more about the miners.
Well, the fundamentals are strikingly similar to when you and I did a uranium interview a year ago, which is to say that there had been an overhang in the physical market as a consequence of the shutdown of the Japanese reactor fleet and the transferal of Japanese inventory from inventory held as fuel to inventory held for sale. In the face of that, we have a 25 or 30 million pound a year structural production deficit, which is to say worldwide uranium demand increases new mine supply and recycled supply by 25 to 30 million pounds a year. The question was always the inventory. I thought that the inventory would likely be addressed eventually by Japanese restarts, or if not, by the growth in the nuclear fleet in places like the UAE or China. Mercifully for the uranium market, Sprott was able to get control of the management contract of Uranium Participation Corp, and change its form of organization from corporation to trust. And I think that really set the uranium market, at least the spot market, on fire. The spot market had been defined by illiquidity, that is to say, very low volumes, and a lack of transparency, opacity. And when Sprott took over and popularized, that product to scant, 4 weeks ago, that all changed. It's useful for some of your viewers to know that Sprott already has physical trusts listed in Canada, in the United States, that focus on precious metals, gold, silver, platinum, and palladium. And those trusts manage on behalf of over 280,000 investors about $12 billion. And the popularization of the trust format by Sprott meant that 280,000 investors worldwide started to become familiar with the uranium narrative. The consequence of that is that the spot market went from no bid to well bid. I hadn't understood just how illiquid the spot market in uranium was. A relatively small amount of buying, something in excess of 2 million pounds, as you note, took the market up from $30 a pound to $40 a pound. It may be, I don't know, it may be that what you've seen are the professional trading houses seeing a bid coming in the market and holding volumes off the spot market to see if they can't get 42 or 43. In other words, it may be that supply will come into the spot market sooner than later in response to the investor cash managed by Sprott. We will see that. What I will tell you is this: Sprott is going to make application to list that trust on the New York Stock Exchange, where the overwhelming majority of the volume that they enjoy in their precious metals trusts occurs. If that happens in terms of inflows into the trust, if the material is available to buy in the spot market, quote, you ain't seen nothing yet.
Yeah, well, okay, that is a cause for celebration and possibly for concern, depending on which side of the market you're in. For the utilities, they might be concerned about complete lack of inventory. Do you see that? Do you see that happening?
I think that the utilities will be able to contract long-term for inventories. The market isn't undersupplied. at $60 or $70 a pound. The market is undersupplied at $40 a pound. Remember that fully loaded, including the cost of capital, not just mine op cost, but cost of capital, the incentive price for uranium is between, sort of 55 and 65 US dollars a pound. Let's call it 60. Is there adequate supply at 40? No. Is there adequate supply at 70? Yes. Cameco, as an example, has said that they won't restart their shuttered production until they lock in enough volume in long-term contracts that will allow them to make a reasonable return on capital employed. So for the utilities, ample material exists at prices that allow the industry to be profitable.
Right. Well, let's talk about the price first, and then we can talk more about the trust. $40 a pound, is that high enough for miners in North America, at least, to restart their operations in mining?
You probably could restart Cigar, although I don't think that you will see Cigar restarted at 40. For most of the production in North America, while $40 may cover mine site cash costs, it does nothing in terms of incenting new production, and it doesn't earn back the cost of capital. North America, with the exception of the Athabasca Basin, is not a low-cost environment. And the Athabasca Basin is, in fact, a high CapEx destination. To incent new production in the Athabasca Basin, I think you're going to require at least 60 US dollars.
I like to make an analogy to gold now, Rick, and I'd like you to correct me if you think I'm completely off base here. So we know that the all-in sustaining costs for most of the large senior producers are somewhere around $1,000 to $1,200, depending on who you're speaking with, maybe sometimes lower as well. But let's just give an average of $1,100 an ounce. Now, what you're saying for uranium is this is essentially the equivalent of saying we're currently at $900 an ounce for gold, in terms of how cheap it is right now.
I would argue something else, too, that's a little more nuanced, which is to say that all-in sustaining costs doesn't take into account prior year write-downs, which in both the gold and the uranium market have been very high. It doesn't show up on the balance sheet, but it does speak to the investor's cost to develop a pound of production or an ounce of production. More importantly, it doesn't call into account the cost of capital. All-in sustaining costs is an artificial number. It's bad. It's not as bad as the numbers that used to be bandied about, but all-in sustaining cost does not take into account the total cost of production, including the generalized, non-specific general and administrative expense, but more importantly, the cost of capital. And companies don't exist without a cost of capital. So I would argue that the AISC that you see in the uranium space and the gold space is artificially low. It doesn't go to things like opportunity cost.
Okay, but the parallel I was drawing was that uranium is severely cheap, even taking into account your point about the all-in sustaining cost being underreported. Would that be a fair assumption to make right now, that even at $40 an ounce, a pound rather, even at $40 a pound, even after a 33% spike in a matter of weeks, we're still severely undervalued?
Absolutely. I would suggest that the only producer that has long-term solvency at US $40 a pound is the big Kazakh producer, Kazatomprom.
Okay. Can you share maybe just a little bit more information about the Sprott Uranium Trust, from the idea of the inception to the launch? Why now, basically? Why this year?
Well, we've been trying to get control. I say we. I'm not an employee of Sprott anymore, although I'm a large shareholder and director. Sprott has been trying to get control of the management contract there for 3 years. So the best answer to why now is because we were able. The arithmetic around the uranium market has existed virtually unchanged for 3 years, although the supply deficit ate away at the above ground inventory. So our timing was probably particularly propitious. But the truth is that Sprott has existed as a contrarian investor in natural resources through its whole time on Earth. You'll note that our gold and silver trusts were very, very, very active during the bear market for gold and silver. And despite those bear markets, we built up large assets under management. So the sort of contrarian sense of natural resource investing is baked into Sprott's DNA. Well, we'd like to take credit for brilliance, which is to say, timing our entry into the market perfectly with regards to tightness in the spot market. That didn't occur. It was really a consequence of being able to arrive at a transaction that suited all parties.
Do you know roughly how much physical uranium was bought as part of the backing for the trust so far, and how much more Sprott plans to buy in the coming months or years?
Well, those are difficult questions. We've bought according to publicly available information. By the way, that information is available daily at the Sprott Physical Uranium Trust website. We have bought something over 2 million pounds in 3 weeks. The next thing I'm going to say is speculative because I'm a director of Sprott, not an employee, and I don't know. But I would suggest that the widening premiums that you're seeing in the Sprott Physical Uranium Trust, that is the fact that we're selling above net asset value, suggests that we're beginning to experience physical tightness in the spot uranium market. We can't issue new units if we aren't able to deploy the cash fairly quickly within 30 days into physical uranium. And I could only speculate that given the fact that our stated goal with the at the market financing mechanism is to issue new units and buy new uranium whenever the market allows us to do that. Well, we're having pretty good inflows of buying. I would suggest that the fact that the premium has broadened out to over 12% would suggest that at least in the near term, we've exhausted the spot market's ability to satisfy our demand.
Okay.
Now, whether that is because of an absolute lack of physical supply or not is a different question. It could easily be that the various uranium trading houses have seen the move in uranium from $30 to $38 or $40. And they said, let's hold off a little bit. Why wouldn't we try and get 42 or 43 or 44 or some number like that? Or there might actually be a change in sentiment. If the changing political winds, and by the way, the political winds are changing. If the political winds gave, as an example, Tokyo Electric Power some confidence that the pace of their restarts would increase, then that inventory that you see as inventory held for sale becomes inventory held for fuel. And then, I'm not saying this is true, but if it's true, then you have pardon the pun, but a truly explosive uranium market in front of you.
We want that figuratively, not literally. But yes, you're absolutely right now, Rick. I want to talk about the uranium miners because, interestingly, uranium miners picked up long before the physical metal started to pick up in September and late August. So at the current valuation, I'm just taking a look at an ETF, for example, the North Shore Global Uranium Mining ETF, which is a basket of several different miners. It's currently trading at about $76 a share. That was that ETF was trading at around $20 a share just last year, about a year ago. Exactly a year ago in September, it was trading at $29 a share. So significant upside. Has this already? First of all, let's talk about what happened and why the miners ran up significantly, even without the uranium market having moved much at all.
Well, one thing is that there is a class of investors that were around for the last uranium bull market. I'm one of them. And the set of circumstances in this market is eerily reminiscent to the last bull market, which is to say, starting off in a deep depression. Back at the time that you and I had our uranium interview, nobody cared about uranium. Well, that was attractive to contrarian investors, but the arithmetic was always the same. The stuff cost 60 to make, and it sold for 30. So the industry was making $30 a pound and trying to make it up on volume. Intelligent investors knew that either the price of uranium would go up or the lights would go out. And most speculators thought that as a consequence of that, that the price of uranium would go out. The other thing that happened is that the market capitalization of uranium producers was so small that it didn't take an awful lot of buying to drive those prices higher. So you had an extraordinary narrative that had been proven to be lucrative 20 years ago in the last bull market, a narrative that was true, and an extraordinarily thin market. The three of those came together to generate a response in the uranium equities that certainly outpaced the response in uranium itself. And as you accurately pointed out, preceded it.
Yeah, preceded it by a wide margin. I haven't seen that in the precious metals market last year. My question now is, do you think valuations are too high for someone to get in now? If for someone who has not paid attention to the uranium market, but is paying attention now after this 33% rally in the metal, he's probably thinking, well, I want to be exposed to the miners, but it's already run up more than 200%.
I hope your listeners pay attention to this next segment very carefully.
Yeah.
If an investor or speculator has a 2, 3, or 4 year perspective, these stocks are still reasonably priced. If that same investor has a 6-month to 12-month perspective, these stocks are likely ahead of themselves. Great work done by a former colleague of mine, Mr. Aditya Patanayak at Sprott, suggests that there are 63 or 64 companies that purport to be in the uranium business, either explorers, developers, or producers worldwide. And based on publicly available PEAs, PFSs, and BFSs, that the uranium equities now are pricing in at a 5% discount, net present values that suggest $50 to $52 per pound yellow cake. I would also point out that investors or speculators who tend more to arithmetic rather than narrative, that is, people who are looking for value and relative value relative to exploration upside, probably would be better off looking at the larger companies, the Kazatomproms, the China General Nuclears, and the Camecos, rather than the companies that gave us those extraordinary moves in the 2000 to 2006 timeframes.
Okay, excellent. Well, there's still hope out there for someone who has missed the boat. I'm sure there's going to be a lot of FOMO trading now in the uranium market after that big jump we saw in the last couple of weeks. And before we let you go, Rick, let's talk about your ranking system for miners at large, not just for uranium miners, of course. How timely it is we were talking about mining and ranking miners at a mining conference. I know you can't be here with us physically, but nonetheless, you're here with us in spirit. Tell us how you rank miners and how investors should pick their miners.
Well, I rank them, including thousands for Kitco listeners, on a 1 to 10 basis. Investors submit their portfolios to me. Natural resources only. Please no pot stocks. Please no cryptocurrencies. Please no technology. And I rank them 1 to 10. My primary ranking criterion is a bit subjective in the sense that it attempts to establish a risk-adjusted net present value, which can be tough to do for exploration companies, and to pay attention to the delta between price, that is what it's selling for in the market, and value, which is to say what we think it's worth. We also err, if that's the right phrase, or value subjectively on management quality, management track record, but in particular, management track record applicable to the task at hand. In other words, are the people attempting to do something that they've done successfully before? And we look for companies that have enough capital or enough access to capital that the business plan that they have in place, which is designed to generate us value, is funded, or where we have the ability to see them be funded. So I would suggest that our ranking criterions are fairly conservative. As an example, with regards to number 1 rankings, 1 being the best, I believe in 30 years of ranking, I've awarded 9 1 rankings out of over 1,500 companies ranked during that period of time. So a 1 ranking is extremely scarce. An 8 ranking, which is to say an outright sell, is fairly common. So you'll find my rankings to be fairly conservative. Any of your listeners who would like to subject themselves or avail themselves of that test are invited to go to a website, sprottusa.com/rankings.
You know, somebody should make a trading instrument or algorithm based on your rankings. You just sell all the 8s and buy all the ones and twos. I don't know why anyone hasn't done that yet.
You'd have a very skinny buy side selection. Ones and twos are extremely rare. You could probably do it by selling the eights and buying the threes.
Yeah,
The threes have been really stellar picks in the last few years.
One more question regarding your ranking. Do you think all resource investors, regardless of their experience or age, should adopt the exact same picking criteria as you?
I don't. I think that it's suited to my own needs and perceptions. Many of your viewers and listeners are probably shorter term oriented and probably more traders. I always take a sort of a 2 to 5 year time frame. In my speculations, I'm very, very, very much geared to taking the risk that is required to generate 10 to 1 returns. But 10 to 1 returns can take 4 years, 5 years, 6 years, and expose one to substantial volatility. So I think what individual investors and speculators need to do is take stock of their own needs, their own risk tolerance, both financially and psychologically, and use other people's platforms, such as my own, to ask them questions about what generates value for them. And they need ultimately to develop their own system. And they need to employ the discipline that comes from having a system.
And what's the link that they should be visiting to access this service?
SprottUSA.com/rankings.
Okay, well, we'll put that in the description of the video as well. Rick, thank you for joining us virtually at this conference, and I look forward to speaking with you again soon. Thank you so much for your time today.
It's always a pleasure. Thank you so much for having me back.
And thank you for watching Kitco News. Stay tuned for more.
Kitco News special coverage of the Precious Metals Summit is brought to you by Corvus Gold.